Hey, welcome back everyone. This is Uncle Frank, and I am not a financial advisor, nor is any of the content to be construed as financial advice. This channel is for entertainment purposes only. Hey guys, check this one out, breaking Wednesday night from Market Watch. The Fed launches new exploratory analysis in stress test with eye on hedge fund losses. The U.S. Fed Reserve included a new facet of its annual stress test designed to explore additional hypothetical risks to the banking system. This year, the Fed studied the rapid repricing of deposits in both a more severe and less severe recession, and concluded that in each scenario, bank capital ratios would stay above minimum capital requirements. The Fed also studied trading book stresses, including the failure of 5 large hedge funds that could cost the largest and most complex banks between 70 and 85 billion. Now guys, I want you to remember that for the next slide. The Fed ran an analysis with 5 hedge funds taking the pipe and everything came out roses, right? The results demonstrated that these banks have material exposure to hedge funds, but that they can withstand different types of trading book shocks, the Fed said. The Fed added the exploratory analysis is distinct from the stress test in that it doesn't have a direct impact on capital requirements. I would like to point out to the Fed boys that one hedge fund, Archegos, that's in court right now, took down a 167-year-old Swiss bank. The Fed is only 110 years old, by the way. Now, in case you guys forgot or you're new to the channel, I'm a position trader that studies forward events, specifically white and black swans, and how they may impact markets on days where markets are already digesting economic data and releases. Sudden, unpredictable events that might adversely impact the leverage chains of our enemies, being the predatory short hedge funds and the prime brokers that back them up. Some of these funds are leveraged 60 to 1 or even higher, and this is their sole Achilles heel, like Archegos and one of its prime brokers, Credit Suisse, for example. You may not want to hear it or agree, but under what I think will become known as the Gensler era of capital markets history, I don't think we have an ice cube's chance in hell of beating all these entities if they're united against us, which I believe they are. What I mean to say is if the retail brokers, predatory hedge funds, prime brokers, market makers, the limit up, limit down committee are all permitted to break the securities rules and laws with impunity, and FINRA and the SEC are going to do absolutely nothing about it except attack CEOs that try to save their own companies from these attacks, we have little or no chance of winning on a heavily shorted trade without a black or white swan event. You can disagree if you like, but I don't care. Consider this headline from 2009. Hedge funds took a serious hit in 2008. Nearly 700 hedge funds shut down in the first 3 quarters of 2008, up over 70% from the same period the prior year, according to Hedge Fund Research, a Chicago-based data firm. As far as I'm concerned, the environment Wall Street is in right now is exactly what you've seen over the past few years on TV. When you see a half dozen kids run into a Walgreens and steal everything and run away, and the police aren't even called anymore, how is that any different than what we've seen nearly every day on the AMC or GME trades? Unchecked spoofing, naked shorting, disappearing FTDs, misuse of dark pools and algos. You tell me, how is it any different? They act like they have permission to cheat, and I believe they do. The worst thing that can happen is they will pay a small fine and resume cheating immediately. What I'm trying to point out is I'm delighted the Fed's little stress test worked out when 5 hedge funds take the pipe. But what if 500 go down? Am I right? Okay, so what happened Wednesday and what's on deck for Thursday? S&P closed up 0.16%. The Dow up 0.04%. NASDAQ added 0.49%, all green. Russell 2000 did go down 4.23 or 0.21%. Crude oil pretty steady, 80.71. Gold held on to 2300 at 2308.6. But Thursday morning, 8:30 a.m. Eastern Time, initial jobless claims, second revision figures on GDP. Then at 10 a.m., pending home sales. But at 9 p.m. is the first Trump and Biden debate. Here's hoping Sleepy Joe is all hopped up on Adderall and has another corn pop story. But it's all about Friday. The entire PCE group of data drops. That's the Fed's favorite, along with personal income and spending, all at 8:30 a.m. So unless a SWAN comes along, the street will be fixated on PCE. And here's what they're saying. Fed's preferred inflation gauge set to drop to 38-month low. This could provide the impetus for another rally to fresh highs. So traders are preparing for the release of the personal consumption expenditure price index data, widely regarded as the Fed Reserve's preferred inflation measure, scheduled for Friday. The Bureau of Economic Analysis will release this key inflation indicator alongside data on personal income and personal spending. The key focus for investors is whether the Fed's inflation gauge has decreased as economists currently predict. A drop would bolster confidence in efforts to steer price pressures towards the 2% target and strengthen expectations for upcoming interest rate cuts, which the street is expecting will happen in September, right? Okay, so on your screen, what economists expect. The PCE is expected to slow from 2.7% year-on-year in April to 2.6% year-on-year in May. As estimates gathered by Econoday show, the consensus range is between 2.5% and 2.7%. Not much help there. On a monthly basis, the PCE is seen advancing at a 0.1% pace, slowing down from the previous 0.3%. The core PCE index is set to ease from 2.8% to 2.6% year-on-year in May, which could mark the lowest level since March of 2021. On a monthly basis, the core PCE price index is predicted to slow from 0.2% to 0.1%. I want my subscribers to know we are 84 days to the second day of the September Fed meeting. That's when everyone is convinced we're going to get a rate cut, right? We're also 131 days from the election date of November 5th. These are going to be market-moving days and even weeks, no doubt in my mind. But if PCE comes in cool, we should get a rally, right? But will it morph into a blow-off top? Will we end up using that rate cut to save the economy if there's a subsequent serious correction or a crash before September 18th? What if PCE comes in hot? Does that push out the September rate cut everyone wants? Will the market sell off Friday, and by how much? Well, a SWAN of either color can change the math on all of this instantly, and I believe there's a 30% chance of a SWAN event before September 18th and a 50% chance of one before the election date of November 5th. What do you guys think? So under the heading geopolitical SWAN risks, I see, of course, Russia, Ukraine. Now, if there's a sudden ceasefire or everyone decides to go to the peace talks, that would be a great white swan, but that's not what we're seeing. Over the past couple of days, we've learned the North Koreans are actually sending troops to Ukraine, still launching balloons into South Korea and launching missiles towards Japan again. My question is, what if they hit a Japanese or South Korean target by mistake? Tensions in China and Taiwan are still high. The conflict between Israel and Hamas is still going on, and now they're concerned that Iran or Hezbollah will get directly involved. And I consider the 2024 election itself a potential SWAN event. Now, under systemic or financial, I've got the commercial real estate crisis. We've identified 282 U.S. banks at risk. Of course, there's BRICS and the de-dollarization trend. We've got $34 trillion U.S. debt spiral to be concerned about. Ryan Cohen could make a sudden announcement about that $4 billion war chest. Is he going to start a new business or buy a new business, right? That could be a white swan for both GME and AMC investors. We could get another sudden roaring kitty post. We could see the settlement of the SEC versus XRP finally resolved. And then there's what I call the derivative tsunami, still out there. Of course, unrealized losses for both the Fed and the banks. And then the hedgy hidden over leverage, securities sold yet not purchased. Who knows how many unreconciled synthetic shares are out there. Lots and lots of swans in the air. Okay, both Donahue George and CSI are going to shit themselves when they hear this one. Spectral AI supports naked short selling inquiry. Get this, Dallas. Spectral AI Incorporated, NASDAQ symbol MDAI, an artificial intelligence company focused on medical diagnostics for faster and more accurate treatment decisions in wound care, today announced that it has provided support to NASDAQ and the state securities authorities in Florida, Louisiana, and Texas to bring their attention to potential market manipulation of the company's common stock, primarily in the form of naked short selling. I kid you not. This inquiry is being led by Eric Sprangenberg, a member of the board of directors and the company's largest shareholder. So this medical AI company is using its software to expose the naked short selling of its own company stock. These guys better be careful, or Gary Gensler will investigate them. Am I right? I think you guys are really going to enjoy this piece from Newsmax Money. Goldman Sachs. Hedge funds' top picks are struggling. Now, this article is by Jeff Garbix. He's a principal at Quantitative Partners. I think this guy's a gem because not only does he expose how the hedgies are struggling, he even points to some stocks that they may be vulnerable in. From the article, are hedge fund managers good or bad stock pickers? If you followed the Goldman Sachs Hedge Fund VIP Index, the answer would be not very good. How can we make such a statement? Actually, it's pretty easy. We have a technical rank that tracks the return of a stock against the return of the S&P 500. GVIP tracks the top holdings of hedge funds that are primed at Goldman Sachs. Our technical rank tracks the return of a stock against the S&P 500 over the last 100 trading days, almost 5 months. Current technical ranks cover from the end of January through the end of June. Only 13 stocks have a technical rank of 60% or higher, which means they are beating the S&P 500. 12 names are ranked 50%, which means they are tracking the S&P 500. GVIP has 49 stocks in the ETF. 24 stocks are underperforming the S&P 500, which is roughly half the universe. Not good. It's nice of Goldman Sachs to produce this ETF as we can use it to help understand our performance relative to the hedgies. Right now, we would avoid the names that are widely owned by Goldman Sachs managers and are underperforming, as sooner or later they will be sold if they do not begin to rise. Buy names that are beginning to improve and could be subject to a short squeeze. Jeff goes on to say, case in point, Capri Holdings, or CPRI, is heavily shorted and ranks very weak technically. If it can turn around, then let the squeeze begin. He added, what is also interesting is that 28 of the 49 names have either moderate or heavy short selling. That means that hedge funds like to, quote, eat their own, or they are cannibals. Hedge funds that buy a heavily shorted stock like Nextera Energy, or NEE, are definitely making a bet that a short squeeze will ensue and enable them to make some nice money. As such, this GVIP is a great place to hunt for interesting long and short ideas. So this guy gave us a couple of picks to look into. Now here's where I think the shorts have it really wrong on Archer Aviation. I believe before the end of next year, people will use the air taxi system to fly from Napa to Oakland in 12 minutes instead of driving 1 hour and 20 minutes. People will be able to fly from San Jose to San Francisco in 10 minutes instead of driving 1 hour and 15 minutes. I think this thing is going to work. Not investment advice or advisor. Well, there's been a steady stream of hit pieces against GameStop. From Yahoo, trading GameStop stock is like gambling, warns trader. GameStop stock down as veteran slams Roaring Kitty. Why GameStop stock investors are flying blind. But this is what they refuse to talk about. GameStop has better valuation metrics than all NASDAQ 100 companies. That's right, it's become the most dangerous SPAC in history. From that article, as of June 14th, GameStop's price-to-cash ratio stands at less than 3, a figure that outshines all 100 companies listed in the NASDAQ 100 index. This metric, which compares a company's market value to its cash reserves, is a crucial indicator of financial health and stability. With a price of $27.50 per share, GameStop's low price-to-cash ratio underscores its potential for being undervalued relative to its cash position. So yeah, that article was from the 14th. GameStop is lower since then, but that only improves that metric. That's right. This all hinges on what Ryan Cohen does with the $4 billion in cash he has. Will he start a new business? Will he buy an existing business? Those are the big questions. If I were him, I'd buy a stock and retail brokerage firm to compete directly with Robinhood. He'd have millions of investors overnight. You'd be able to route your own orders and turn off share lending if you chose to. They could call it GS trading or GME trading. I would also open a crypto exchange and maybe even a third separate company just for online gaming and gambling. The bottom line is GME will be plagued by the shorts until Ryan makes an announcement. Maybe he's waiting for after a big correction. We'll see. AMC is in the same boat. No amount of good news or regulatory crackdowns will help the stock price, in my opinion. It's in the same short bucket as GME, and if GME rips, I believe AMC will track it up. Not investment advice or advisor. Ryan Cohen's announcement or the next Roaring Kitty tweet could turn out to be the white swan. It's that simple. Hey, I want to thank you for watching, and please remember to hit the like button after this slide if you enjoyed the presentation. Subscribe to the channel and set the alert so you're notified when I have new information to share. See you at the bell.